Welcome back to America's Retirement Headquarters, home of the Retirement Guys formula and America's Medicare Associates. 419-794-3030 is the phone number. Once again, 419-794-3030. Online, americasretirementheadquarters.com, or if you prefer shorter, arhq.com. I think we all know that bonds did not perform well last year, but now they're actually paying the highest yields in more than a decade. It's so attractive that some financial fund giants are actually recommending a shift from the classic portfolio of 60% stocks and 40% bonds. They're now saying a mix of 35% stocks and 65% bonds should yield a 6.5% annual yield. So I've heard a lot of differing opinions on what bonds are going to do this year. What do you think? Are bonds back in favor right now?
That's probably going to be a big question. I think people are going to be asking, are bonds a good investment in 2023? We're going to talk about the numbers really in depth at our upcoming economic summit. That economic summit's going to be held in the end of February at the Hilton Garden Inn. It's probably one of our most popular events where people come and, they learn about the market conditions and where things are at. But if we look at it, looking at the data that was out there, we had bonds. I think what I had heard is 2022 is the worst year on record for bonds. And I guess it depends on what bond you look at. But overall, bonds really did get beat up quite a bit. So when things go down, is the likelihood that they will come back to the norm? Yes. If you look at some of the statistics that are out there, as interest rates have gone up, bonds become much more attractive. Some of the fund giants that are writing this article, BlackRock and Vanguard, they do say some of the higher yields, higher quality corporate and mortgage bonds are attractive, when you compare it to stocks. But to kind of give a blanket answer of, do this allocation versus that, it's really not taking into consideration, somebody's own individual situation. It's, troubling, I think, when you hear articles that say all investors should do X, because, again, it comes down to what their individual goals and objectives. Somebody who's still working, maybe they're not necessarily considering or worried too much about yield. Yield is what we think about when we think about people that are close to or in retirement time that need money. Now, as what we do in helping people, looking at income and yield is also important. We also should say that whether it's our show, whether it's our economic event at the Hilton, or whether it's our articles online, or whatever article you see on the nightly news, just realize the market doesn't care what our opinion is. The market's going to do what the market's going to do. There are other strategies out there where you can achieve similar results and maybe look to lower the risk. Because here's the challenge. Whether it's a 60-40 stock or bond portfolio, or whether it's a now 35% stock and 65% bond portfolio, the reality is both of those categories at the end of the day are going to do whatever the market thinks that they're going to do. We did a lot of presentations here recently, and one of the questions that I've been asking at our presentations is I've been asking people, hey, in the near-term future, the market is either going to go up another 20% from where we're at today, or it's going to go down 20% first. I think we would all agree over the long term, America is the greatest country ever. It's going to take care of itself. But one of those two things is going to happen first. Bad things like what happened in 22 are going to continue on. Things are going to get worse. Market and economic conditions are going to go down. Those people that predict the big recessions coming are going to be right. The other thing is market has hit bottom. We're moving in the right direction. Things start to go back up. And I asked the question, which will happen first? Scott, I think you've been in a couple of these events, and what is shocking to me is that, I would say 90% plus of the audience right now is raising their hand to say down first.
Right.
And what's troubling about it is the stock and bond market are in auction. So the more people to show up to buy, the higher the prices go. The more people show up to sell, the lower the prices go. And so if investors continue to panic and they drive prices down, it doesn't matter what the asset allocation is in the portfolio, and investors still might take another 1-2 on the chin with this market and the uncontrollable. So things to consider when you're looking at bonds is, one is you could own bonds individually, and that would be a way to eliminate some interest rate risk that's out there. And if you hold the bond to maturity, whatever the issuing agency of the bond is, the backer of that bond, That can help reduce some volatility in the portfolio. Secondarily, if you look at alternatives that are out there in bonds like multi-year fixed guaranteed annuities, a lot of these products are paying, in that 4, 5, 6% range without taking the interest rate risk or the market risk with your bond funds. And so you can bring down that volatility. In the article that BlackRock and Vanguard talk about, the high yield, it may seem attractive. The word hasn't always been high yield. Years ago, they used to refer to them as junk bonds, but it's not cool to call them junk anymore. Right. So what a high yield or a junk bond means is a bond that doesn't carry as high quality, as high as of a rating as other bonds. And so in turn, they had to pay more. It's no different than the guy who doesn't have good credit has to pay more for a loan, whether it's a car or mortgage. The same would be true with corporations. Those that don't carry great credit have to pay more to investors. But be careful of default risk, because if they don't have good credit now and we do go into a deep recession, what does that mean on the bond's ability and that bond company to stay in business? So there's a lot more to the story, and figuring out what is right for you comes down to developing the right recipe with what you're comfortable with the level of risk. In conclusion, in my opinion, I believe there are opportunities in the bond market right now based upon the big pullback that we have. We have made some changes in some of our models to start to add in bonds early on in 2023 to capture where we believe there's some recovery, but I also still believe that there's some bombs that are out there that you have to avoid. And so if you're not sure what you own and what your time frame is, that's where having somebody do that portfolio analysis can kind of help figure out what may be the best mix of investments in your portfolio. And if you're not sure what your mix is today or what your mix should look like in the future, that's where either getting a first-time meeting with our office or a second opinion could be able to be the best decision you made for 2023.
And it could go a long way, because again, if there is a small thing that you can fix that's really going to tighten up your retirement prospects, wouldn't you want to know about that as soon as possible? Wouldn't that be to set you up for more success down the line? I think so. And so it's critical. You go ahead and schedule that time and figure out what those changes, if anything, need to be made. Best case scenario is you find out you're doing a great job and you stay the course. Worst case scenario, and I don't even want to say worse, is you find out what those problems are, but once you do, you can address them head on and start course correcting to tighten up your retirement prospects. That all starts with that phone call, 419-794-3030. Once again, that's 419-794-3030. You can always find them online, Americasretirementheadquarters.com, that full list of events, and schedule a time to attend one of those, Americasretirementheadquarters.com or ARHQ.com. Want to thank you, as we always do, for joining us this week here on the show, joining us here on America's Retirement Headquarters with Nolan Baker and Scott Kirshner. Please have a great week. Be safe out there. Guys, thank you for the time as always. And as we wrap up, I want to leave you with the final word.
Yeah, just appreciate everybody taking time. If you haven't liked or subscribed to us, I encourage you to go over to YouTube, type in America's Retirement Headquarters. Make sure you subscribe to our How to Retire series. It's as easy as smashing that subscribe button there on YouTube or on Facebook. You can follow us. We've got a lot of great information. We'd love to connect with you. Send us your questions. Let us know your comments. Let us know what you like about the show. And we're always happy to answer your questions and comments that you have as well. And just remember, when you think retirement, think America's Retirement Headquarters, home of America's Medicare Associates and the Retirement Guys formula.